All right, now in the previous 3 educational videos in the previous week, we focused on bias. So understanding again, first what bias means, then moving on to candle direction, candle signs, and also order flow direction. With that understanding, we can now slowly start to move on to narrative as well, where we start to combine bias with narrative. Before we do that, let's remind ourselves first of the basis. Again, these foundational levels right here, they lead you to a trade ID. So this is always what we want to focus on. So we start off with 1 bias, 2 narrative, 3 boundary, 4 target, then 5 entry, 6 risk management, which leads to a trade ID, leads to a trade outcome. If you understand these foundational levels very well, you understand them in the right order as well, that means that most likely you are highly profitable as well. So to give you an understanding, on YouTube, for example, I might go from risk management to all of a sudden narrative in the next video to then all of a sudden target. It's all over the place. Where here we focus on these foundational levels constantly in the right order. So if we are talking about something, then it always fits into one of the foundational levels. So my advice would also be, if we focus on bias, then please do not focus on entries just yet, because you're going to switch from 1 to 5 to then 5 to 2 again, to then maybe from 2 to 6. You're going to be all over the place. So that's why we have structured it like this. Again, that is important to understand. That's again the setup for success, little reminder. Now, we need to of course know what we are talking about if we talk about the analyst phase. And the analyst phase is again the bias, the narrative, the boundary, and for the target. We see bias is in green, narrative is in red. And that is because we have gone over bias. We are about to go over narrative as well. Again, bias is not done. So if you do not fully understand the bias just yet, no worries, because bias is always going to return. It's the first foundational level in a trade ID, meaning it's the first thing we do. Whenever we open a chart, that's the first thing we do. So it's probably the most talked about as well, because if we can't get to a clear bias, then we can't move on to narrative. So bias is the most discussed topic as well, which eventually will return. That's why we had candle signs part 1 and order flow part 1. So no worries. Now, if we move on to narrative, we of course do have to understand what narrative actually is. And especially if we want to combine bias with narrative, let's again remind ourselves of what those two things mean. Bias is the direction. So we purely focused on the direction. No entries, no how can we deliver there, just purely the direction. That was again done through the drawn liquidity that leads to overall an understanding of the direction. Now, with that understanding, and if we know we are going higher, for example, and the drawn liquidity is a premium array, then the narrative is, how are we getting there? So if we are going higher, where are we going higher from? Or if we have a bearish direction and we are heading for a discount array, then if we are going lower, where are we going lower from? How are we again getting there? That is the narrative. And if we are having a bullish bias, a bullish direction, we expect higher prices, we aim for a premium array, then we are getting there through a discount array. So if we aim for a premium array, then a discount array will get us there. If we aim for a discount array, then a premium array will get us there. That again is through the PD arrays right there. That's understanding that order flow. There's understanding that unloading of orders and adding new orders. If we unload new orders because we have a bullish direction and we unload or we unload previous orders, at premium arrays, and we add new orders at discount arrays, that again leads to the bias and the narrative, because we are adding new orders at discount arrays. Now, that order flow lags. And when we talk about order flow lags, that can be dissected again through then float, odd, and lot. First line of defense, overlapping defense, and last line of defense. And before we do that, before we dive into anything, we need to understand the PD arrays dissected again. So if we move on and we understand how we dissect the PD arrays, this is a little reminder as well of what we talked about in the previous educational videos, where we talked about the red, the black, and the blue right there. And that led to the understanding of the superior, the fair value areas, and the liquidity. So the superior is again the fair value gap, then the fair value area right there is the order block, mitigation block, breaker block, and then the liquidity is swing points and previous candles. So previous candle high, previous candle low. Now, with that understanding, we can now move on to the understanding of flood, odd, and lot. Because we have an order flow lag dissected, meaning when we have an order flow lag, that's again a swing high with a fair value gap lower or a swing low with a fair value gap higher. That's all fun and games, but we need to dissect that. Why is that? Well, in trading, you're going to use a stop loss, meaning you're going to have an invalidation point. So ideally, we want to be as accurate as possible. Well, actually, we need to be as accurate as possible for our stop loss not to be hit before our take profit is actually hit. So we need to have an understanding of where price has no reason to return anymore. So we need to know quite accurately where we can actually continue higher from. So an order flow lag in itself is quite nice, but does not give you accuracy. Because we can maybe on the 1 minute time frame, because again, then your stop loss is of course already quite fast in the right place. But if we are talking about a daily time frame, then using a daily stop loss for a 5 minute entry, that's not going to be ideal, right? So flood, odd, and lot, where the flood is the first line of defense, oftentimes an FVG in high probability conditions. Then we have the odd. The overlapping defense is always going to be an order block, a mitigation block, and or a breaker block. Then we have fair value areas right there, of course, because they are the order block, mitigation block, and the breaker block. They are fair value areas. After that, we move on to the lot. And lot is last line of defense, which is always going to be a swing point right there. So swing high or swing low, or previous candles. So previous candle high or previous candle low. So we can see again that we have superior fair value areas and we have liquidity right there. That is the ideal order. Again, does that mean that that is the exact order and it can't change? No, that's what we're going to go over right now. If we want to understand the first line of defense right here, then we need to understand what a first line of defense can be. What we are seeing right here is a hierarchy, meaning in high probability conditions, so the best trading conditions that you will have, the fair value gap that we see at the top right there is always going to be the first line of defense. But that does not mean it's always going to be the first line of defense, because if the trading conditions are a little bit less, so a little bit lower probability to overall play out, then it can also be a fair value area. But again, not only fair value gap or a fair value area, it can also be a swing point. And that is the lowest probability for price action to do. So when we have a first line of defense being a swing point, that's the lowest probability thing for price to actually create. The highest probability is a fair value gap. After that, a little bit lower probability, but still in some conditions, high probability is going to be a fair value area. After that, the lowest probability is going to be just a singular swing point right there. So what does this look like in a chart? Here we are on a GBP Canadian dollar on the daily time frame, and we used this pair right here as well for our order flow video. And when we take a look at this, we see multiple order flow lags. This is an order flow lag right here. This is an order flow lag right there as well. And this is also an order flow lag right there. They all have a different first line of defense, where the first line of defense is again understanding the first line of defense is simply the first, in this case, discount array that we come into that we can potentially continue higher from. So the defense part is talking about PD raise. The first line is just simply the first one that we come into. So with this one right here, this order flow lag higher, the first one we come into, the first line of defense, is a fair value gap right there. Because we do have a fair value area sitting right there as well. And this fair value area in the form of the order block, but those are lower, the openings of those are lower than the fair value gap itself, meaning that the fair value gap right there is the first line of defense. So that is again the highest probability example that we can have. When the fair value gap is the actual first line of defense, that's the highest probability thing we can create. Then after that, if we move on to this leg right here, this oracle leg, we again see the same thing right there, where we do have that fair value gap and we also have this fair value area right there. So which one is higher? Which one is the first one we come into? It's again the fair value gap. So that again is again high probability right there, because we have the fair value gap as the first line of defense. Now, if we take a look at this one right here and we take a look at this leg higher, we see this fair value gap. We have a fair value area, an OR block a little bit lower, but that fair value gap is not the first line of defense because we have a fair value area actually sitting right there. Again, we need to understand, right? A fair value area is only valid if we actually have a fair value gap. So that means once we have an order flow leg higher right there, and we then also create a fair value area form right there, and that means if this fair value area is higher than the fair value gap, this fair value area is actually the first line of defense, because that's the first discount rate that we actually come into right there. That is lower probability overall. Why is that? Because that is understanding that is less intention. When a first line of defense is not a fair value gap and it's a fair value area, there is overall less bullish intention than if we had a fair value gap as a first line of defense. Because we can see right here that this is trying to push higher, but there's a long wick at the top, etc. So since this fair value gap is not the first line of defense, there is less bullish intention than if the fair value gap, for example, like this one, would have been the first line of defense. So because we have that hierarchy, and that hierarchy is simply, it's simply saying that if we have more bullish intention, that is going to be higher probability. That's why if the first line of defense is a swing point, that is going to be the lowest probability. And the reason for that then is, again, because we have overall less bullish intention, because those fair value gaps, again, they show us the intention of price. So if we take a look at this price action on crude oil, we don't have order flow lags, but we do have lags. And lags meaning we have a swing low being created, and after that, we don't have a fair value gap, because if we would have had a fair value gap, then we would have had an order flow lag. So if we don't have a fair value gap, okay, then it's just a simple lag. So this, for example, is a lag higher right there. This, for example, is a lag higher right there. This is also a lag higher right there. Not order flow lags, but they are lags higher. So at this moment in time, we can see that in those lags, we only have one discount rate that we can continue higher from. There's no superior PD rate. There's no fair value gap. And the reason I say superior right there is because if we don't have that superior, then we don't have a fair value area. So that means that we only have liquidity left. So if we only have liquidity left, that's the only place that we can continue higher from, meaning that's the first line of defense. That's the last line of defense. That's everything right there in that simple lag. So at this moment in time, right here, we can see that that is the first line of defense. Why is that low probability right there? Because there's no intention. You can see we are constantly sweeping highs, lows, because there is no intention, there's no fair value gaps being created. So if the fair value gap, again, is the first line of defense, that's always going to be the highest probability option. Where if we take a look at most recent price action right here, then we see the first line of defense, if we want to continue higher, is again this swing low. That is our first line of defense and also our last line of defense. So right now, if we have candle signs supporting the ID, then this could be a very interesting study here as well to potentially continue higher right there. But is that going to be higher probability than a fair value gap as the first line of defense? No. So this has lower probability. This has a less chance of actually playing out than if we find another pair, another instrument that has a fair value gap as the first line of defense. Then one more example right here, where if we have this leg lower right there, that order flow leg, we then create this fair value gap. That again is the first line of defense. After that, we also create this order flow leg higher right there. Now in that order flow leg, we see that we have this first line of defense right there, because that one is located, the fair value area is located above the fair value gap. When you have this as well, oftentimes again, this first line of defense will prevent price from trading back into that fair value gap. So the topic, how far we can retrace, is what we're going to go over later on in this week as well. This again is understanding that if the fair value gap is the first line of defense, it's the highest probability. After that, we have fair value area, which can also be a first line of defense, but that is lower probability. For example, this right here. And after that is understanding if the swing point in both these examples is the first line of defense, which can be true, that is also even lower probability. So we have first line of defense dissected right here. We understand what a first line of defense can be, both three options, but we also understand that with those three options, there is different probabilities for all the three options that we have right there. Then after that, we have, of course, odd, which is the overlapping defense. Now the overlapping defense doesn't change. It's always going to be the same exact thing, but there is differences in overall probabilities again. The overlapping defense is always going to be either a breaker block, a mitigation block, or an order block. In other words, it's always the fair value area. So the overlapping defense is probably the most easy one. It is not super difficult to understand in my opinion, but we do need to understand again, and that leads to the first line of defense. If the first line of defense was the fair value area, that again is going to be lower probability for the overlapping defense as well. Where if the first line of defense was a fair value gap, that again is going to be higher probability for the overlapping defense as well. So what does that look like? So back on GBP Canadian dollar, we again saw these fair value gaps and the first line of defenses, etc. But with those first line of defenses, we also have, of course, the overlapping defense. So the overlapping defense is always going to be the fair value area in combination with the fair value gap. Because without the fair value gap, there would be no fair value area, right? So it's always a combination of the fair value gap with the fair value area. Now, the overlapping defense in this first leg higher is actually this fair value area in combination with that fair value gap. So where do they overlap? Well, what is the whole PD rate that we see right there actually before we move higher? The whole PD rate is this sitting right there. That is the full PD rate. So where do they overlap with the fair value gap? It's at the fair value gap area right there. So when you have a situation like this, then the fair value gap, where the again the fair value area is the first line of defense, and when you have a situation like this, then the fair value gap is going to become the first line, or sorry, the overlapping defense right there. I'll show more examples after this as well. And in this case, this is lower probability. Why is this lower probability? Because it gives you less accuracy. There's less bullish intention, and as well, there is less accuracy. Because this right here, all the area above that fair value gap, that essentially is where you can look for an entry. But in itself, that is quite a big area. So that gives you a lot less accuracy than if you had, for example, this scenario, where the fair value gap is the first line of defense right there, and the overlapping defense is this fair value area. That gives you a lot more accuracy right there instead of a situation like this. So that is why a situation like this, where the first line of defense is a fair value area instead of the fair value gap, that becomes lower probability because of the intention, but also because it lacks the overall accuracy that would have been created if we have a situation like this, where the first line of defense is an actual fair value gap itself. If we take a look at US dollar, Canadian dollar, again on the daily time frame, then once we have this move lower right there, that creates multiple PD rays in that leg lower. Where the first line of defense, the first fair value area is sitting right there. So the first line of defense in this case is again a fair value area. Where then the overlapping defense becomes the fair value gap itself. So we have a small fair value gap, that is the overlapping defense. Again, this right here is lower probability than having the fair value gap as the first line of defense. The same can be said about this leg higher right here. When we have this leg higher, we create, again, very similar scenario, these fair value gaps, but that's not the first line of defense. This right here is the first line of defense. Whenever that fair value area is the first line of defense, that again is lower probability than if the fair value gap itself would have been the first line of defense. Because there's less bullish intention, so there's overall less intention to move into that specific direction, either bullish or bearish. And as well, it gives us less accuracy. Because right here, before we come into that fair value gap, we see there's a lot of messing around. So the fair value gap being the first line of defense, and then after the overlapping defense being the fair value area, that gives us so much more accuracy. That is a lot higher probability as well. So we have a good understanding of what the overlapping defense right here is, and also again the differences between that probability. Now you can probably tell, and I hope you can see that the understanding the probability already starts with understanding what the first line of defense actually is. If the first line of defense is a fair value gap, absolutely perfect. That's the ideal scenario that we would want to see. That's the highest probability order flow leg. From that, moving on to the lot, of course, we can see right here the last line of defense. We have two types of last line of defenses. We have a swing point and we have a previous X high, previous X low. Previous X high, previous X low is again previous candle high, previous candle low. Now, I think the swing point itself is quite clear. I think the previous X high, previous X low can be a little bit confusing, or it's not used in our typical context. And I'll show you as well what I mean. When we talk about the last line of defense, we look at any order flow leg that we have going higher right there. And we can break that down again. We have the first line of defense, we have the overlapping defense potentially. In this case, we actually do not have that. And afterwards, we have the last line of defense, which is always going to be that swing low that we have of the order flow leg itself. If we have a bearish order flow leg, in this case, right there, then the swing high is going to be the last line of defense right there. Now, in this case, when it is an order flow leg and the last line of defense is a swing high or a swing low, which is always going to be the case, right? When you have an order flow leg, then the last line of defense is extremely low probability to trade off of. Where, for example, right here, this bearish order flow leg and this last line of defense is not necessarily something I would want to trade off of, because we already knew earlier on that this whole order flow leg was going to fail. So how do we know that? Again, things we're all going to dive into, but it's important to understand right there that the last line of defense, if it's a swing high or it's a swing low, and it's actually an order flow leg, then you would not want to trade off of the last line of defense. That's not an active place where you would want to look for a trade ID. You already want to know that the last line of defense is going to fail before it actually does. So it becomes a target instead of something to trade off of. Where the last line of defense in an order flow leg is actually going to be a previous candle low or a previous candle high, and not a swing high or a swing low a lot of times. At least not something to trade off of. And I'll show you what I mean. Now, of course, if it's not an order flow leg, then the last line of defense, which is also the first line of defense in the form of that swing low right there, that's going to be a higher probability to trade off of than if it's a last line of defense in the form of a swing high or swing low, and it's actually an order flow leg. So that is a lot lower probability and is not something I would want to trade off of unless it wasn't an order flow lag and we just simply have a lag higher with first line of defense and the last line of defense being that swing low right there. Now, back again on GBP Canadian dollar, I now want to go over why the last line of defense in an order flow lag is actually a previous candle high or a previous candle low. So right here, we have this order flow lag higher. We have this fair value gap sitting right there, and we have this fair value area as well. So overall, we are offering fair value right there, which we can continue higher from. We have a nested order block sitting right there as well, but the nested order block is less relevant, like we mentioned earlier on this in videos as well, than the actual fair value area that we see of the bigger picture, because that is where we can now continue higher from. If we do not respect that right there, then we are not offering fair value. So we are most likely targeting liquidity again. So right here, what is now, if we look at this based on candle signs, we come into this daily fair value gap right here and into the fair value area. The first candle does not reject, meaning it's not respecting the overall overlapping defense that we see right there. So what can happen? We can now sweep this previous candle low right there to continue higher off of that. So at this moment in time, what is actually the last line of defense? Well, it's not this low right there. That is also a last line of defense, but that's not the last line of defense, where if we now make this retracement, you're ultimately waiting for this one to hold right there to then continue higher off of that, because it's an order flow lag. And in an order flow lag, if we have any order flow lag, it has a fair value gap in the lag itself. If it has a fair value gap in the lag itself, that is already higher probability than if it doesn't have an order flow lag and a fair value gap in the lag itself, meaning it just becomes a lag like we saw on crude oil, the previous example, then we can aim for the low. If it's an order flow lag, it's very unlikely that we are going to continue higher off of the last line of defense in the form of a swing low. We are focusing on the last line of defense being a previous candle low or previous candle high. Where here, if this previous candle low right there does not hold and does not get swept, and we don't continue higher off of that, then that indicates and that creates what? The dominoes effect that we talked about in candle signs. Because if this previous candle low right there does not hold, we are not offering fair value anymore. The fair value gap is not holding anymore. That nested order block, that's not the most relevant part right there. Can potentially give a rejection, but not to continue higher off of, most likely. So then we have this discount rate failing, and when one of the discount rate fails right there, then all of them start failing, where this last line of defense now becomes a target actually. After that, all these other discount rates become a target. So this is actually the last line of defense right there, that previous candle low. Where at this moment in time, now the last line of defense is, again, based on candle signs, this previous candle low sitting right there. And then until we reach this high right there, we create a new order flow lag. Eventually, well, currently, big retracement, we're not too sure yet what it wants to do. Then that right there becomes a new last line of defense, but the same thing would be said about this new order flow lag going higher as well. And that also leads me back to Bank Nifty right here, which we saw a beautiful dominoes effect on. Now, if we go over this again, we see on the monthly right here, we are not creating a monthly fair value gap higher of a previous monthly fair value gap. A little bit suspicious. So if we want to continue lower right there, what can we continue lower off of? Well, we create an order flow lag right there continuing lower. So if we now want to continue lower, then this fair value gap is the first line of defense actually sitting right there. Where the last line of defense right here is actually, again, not this swing high. It's not those swing highs right there, which we can look to continue lower off of. No, it becomes this candle high right there. And eventually this candle high. But we can refine this even more. Because at this moment in time, if we now, based on candle signs, want to actually continue lower, this is beautiful. We have a beautiful rejection right there. So now the last line of defense for the next candle is this right there, because otherwise we are taking out the rejection. So if we take out that rejection, we are likely not going to continue lower, and we will likely continue higher, targeting the last line of defense which we had in an order flow lag right there. So at this moment in time, we have a down candle. All right, based on candle signs, that's perfect, right? That's exactly what we would want to see. But now the next candle should ideally also be a down candle. So the last line of defense right now becomes this high. Can we still sweep this high? Yes, we can, but we should actually sweep it. And the next candle should as well be a down candle continuing lower right there. The goal should now be creating a new fair value gap as soon as possible, continuing lower. So the last line of defense is moved from that high to that high right there, where it's not actually that high. It goes even deeper, even more advanced. But before I dive into more advanced stuff right here, again, if this is not fully clear, then I would highly advise study this, because this will also come back eventually, where it's a constant thing that comes back. So if it's not fully clear right now, don't worry, you can study it. Try to make it as clear as possible for you right now, but eventually it will become more clear as well. So right here, if we go into the daily, do we have a fair value gap lower? Do we have a new order flow lag lower right now? No. Let's go into the 4 hour. Do we have an order flow lag lower right here? Yes. And the order flow lag lower right there is actually the high, it's the last line of defense that we had on a weekly basis. So the high of that order flow lag lower right there is actually the previous candle high that we saw on the weekly right there. So if we now want to continue lower, we have this order flow lag, where the first line of defense is now this fair value gap right there. Overlapping defense, we have, just mark the order block right there. And the last line of defense is actually this order flow lag high right there. It's a swing high. Now, if we look at this scenario, then we can see what is the last line of defense actually sitting right there. It is this candle, previous candle high right there, once we come into the overlapping defense and the fair value gap. So right there, that is the one, the last line of defense that we should sweep. We should respect right there to continue lower off of if we actually do want to continue lower right there. So right now we respect that. Perfect. We respect the last line of defense right there. We create a new order flow lag continuing lower. So the original last line of defense, that swing high right there, that is now the last line of defense, as in the not previous candle high, previous candle low, last line of defense, the swing point. Now right here, if we dissect this again, we have this fair value gap, we have this overlapping defense right there, and we take a look at this candle right here, where we actually see somewhat of a rejection right there already. Okay, that rejection is quite interesting, but let's say the last line of defense right now is this high. So if we still want to continue lower, we can sweep that high right there, the 2 candle rejection again, to continue lower off of that. That is the last line of defense before everything starts to fill, before we create a dominoes effect. So right here, we sweep that high. Okay, interesting. We have somewhat of a rejection. Perfect. So the next candle right now should do what? Should be a down candle. If that's not a down candle, then everything will start to fill. Right here, we see an up candle. It was looking like a down candle first, and then it's an up candle. So now we are disrespecting the overall bias that we had to continue lower. So what are we doing right here? Okay, now the last line of defense is failing. We have now created a dominoes effect. Last line of defense is failing, and not actually the swing high, not actually the swing low, whatever it may be. It's a previous candle high, previous candle low, based on the 2 candle rejection, based on candle signs. So now all these premium rays will start to fill right there to continue higher actually, because the last line of defense filled, and not the last line of defense is in a swing high, swing low, no, previous candle high or previous candle low filled, which creates that dominoes effect right there. So that is a key element that we need to understand as well. So we understand here in the last line of defense as well, when we ideally want to use a swing point, when we want to look to trade off of that, so when we expect actually the swing point to hold. And that's actually when we do not have an order flow lag. So when it's not an order flow lag, we would expect the swing point to hold. So when it's just a simple lag with no fair value gap in it. If we talk about an order flow lag, Then the last line of defense is 9 out of 10 times going to be a previous candle high or previous candle low before we create that dominoes effect actually. So understanding this, of course, also comes at now an understanding of timeframes. We need to now understand how we want to combine those timeframes to get to the understanding of bias and narrative. So where do we actually start? We start off with the monthly. This is also going to depend eventually on what type of trader you want to be, because if you are going to look at monthly entries, so monthly order flow entries, then of course it will be a little bit different. I am mainly referring right here from anywhere between swing trading, day trading to scalping. So that is what I'm mainly referring to right here. If eventually you want to be a position trader and only trade the higher time frame, that's what we're going to talk about as well, but that's mainly going to take part in the execution phase. So keep that in mind as well. Then you would approach the time frames differently. Now, monthly, you start off with candle signs. Then after, we go over the weekly, the daily, the 4 hour. That's where you can already stop, right? Depending on how the price action, what the price action looks like, is what I will show you as well. After that, we move on to the 1 hour, the 15 minute, potentially. The 5 minute and the 1 minute are in red because they are out of boundaries. In the analyst phase, you are not using the 5 minute and the 1 minute to actually make an analysis currently. It's what we can eventually do, but currently we are just looking at the 50 minute and above right there. Not at the 5 minute and the 1 minute. They are mainly going to serve as an entry purpose eventually. Now, this then leads to overall understanding as well, the basis of a top-down analysis actually. So right here, we start off with the monthly time frame. We are looking at Australian dollar, US dollar. So how would we go about this? For the monthly time frame, I am usually oftentimes mainly looking at candle signs because it takes some time from moving towards fair value gap, creating a new fair value gap, etc. So oftentimes we only look at candle signs actually. What can the next candle do? Now here, and again, this is lucky, we could call it lucky, we do have a fair value gap to work with. So that's quite nice. We're coming off that fair value gap, which currently seems like we are respecting that, so we can continue higher for a little bit. First target has been reached actually in the form of that previous month's high. Okay, what is the next premium rate above that? It's this swing high. That's quite far. So if we want to deliver towards that swing high, let's see how we can now deliver there, where we now need to make use of order flow. So the reason monthly candle signs is important because the monthly is not always going to give you a clear fair value gap to actually trade off of. You're going to find the fair value gaps on the time frames below the monthly. So if we expect bullish prices right here, then what we need to do is go down a singular time frame into the weekly right now, find a fair value gap that will push price higher. In other words, an order flow lag that we can continue higher from. Do we currently have that? No. Maybe once this candle closes, we can talk about an order flow lag that we have sitting right there. But currently, we do not have a discount rate that we can continue higher from right there, unless we are talking about eventually these swing lows, but that's not relevant. We want to focus on an order flow lag that can push us in the right direction. So if we are going higher, then how are we getting there? If we are going higher, where are we going higher from? That's going to be an order flow lag. Do we have an order flow lag like right here? No. So we can go down a singular time frame. Do we have an order flow lag right here? Yes, we do. We have this right here in the form of that daily order flow lag sitting higher right there, which creates right now this fair value gap. We have another fair value gap sitting right there. So what I'm currently doing is I'm just simply marking out every single PD rate that we might have there. We have this fair value area sitting right there as well. Fair value area sitting a little bit lower right there as well. We can even get crazier with all these fair value areas below that, but let's leave it like this currently. And let's even remove that fair value gap. So now the question becomes, all right, we understand we have this order flow lag. So this order flow lag right now is what we can continue higher from right there. At this moment in time, you would also want to stop right here. you would not go into the 4 hour, into the 1 hour, into the 50 minute, into the 5 minute, into the 1 minute, because you've already found the order flow lag that we can now continue higher from by working your way down those singular time frames. So eventually we'll be going to the 4 hour, the 1 hour, the 50 minute, 5 minute, 1 minute, yes. But it's first understanding right now where the higher time frame can actually continue higher from. That will aid us, that will help us in understanding what, for example, the 1 minute eventually wants to do. So first we stop right here. Now, if we now find, and now the question becomes again, where can we actually continue higher from? Because we have the flood, we have the odd, we have the lot, we have all these different types of PD rates in that singular lag higher. Which one is actually the one that we can continue higher from? How far can we retrace? And before we go over that, we need to go over a different couple of things as well. So that is going to be a later video, but the first thing I want you to focus on is just simply the order flow lag, finding the order flow lag that we can continue higher from and dissecting that order flow lag with flood, the odd, and the lot, and seeing how we react off of that. So what we can do, of course, if we now start to respect these discount arrays and we want to continue higher off of those, then what do? We essentially do the same thing that we did with the monthly towards the daily, where the daily now acts as that monthly, because the daily then becomes the candle signs where we see, okay, we might already continue higher, which is seen through then a new order flow lag higher on the 4 hour, on the 1 hour, on the eventually 15 minute, etc. to see if we already have an order flow lag higher to continue higher off that, which at this moment in time, we do not really have. I'm not going to count this just yet, and I'll tell you later on as well why. Now, if we take a look at multiple examples, GBP New Zealand dollar right here, what can we see? What PD rates are close to recent price action right here that we can potentially aim for? Well, we took out this previous month's high right there. We do have this swing high that we can aim for after. Overall, is the monthly quite clear? I would argue not really clear. So let's see what the monthly is actually doing. Oh, sorry, the weekly. So the weekly right here is coming off of previous fair value gaps. In the recent lag, it's creating a new order flow lag higher right there. All right, that is quite interesting. We have this fair value gap that we are dealing with right there. So that is ideally where your analysis would already stop, because now you have found the order flow lag that we might continue higher from. This is where it stops. Now, eventually, again, to remind you, yes, we can work with that fair value gap and that order flow lag itself already. So we do not need to wait weeks before we can get involved, but we first need to have the basis understanding before we can get into the advanced understanding of how we can deal with that as well. So right here, if we do go down a couple of time frames and we go into the daily right there, and on the daily, we actually see this order flow lag is failing right there because we do have something below that in the form of we are creating a weekly order flow lag, weekly fair value gap high right there. Now, the reason I say this is because here on the 4 hour, we actually see something very interesting. We see this 4 hour fair value gap right there, which we could continue higher from as well, right? It's also an order flow lag. This is so important to why we work our way down. Because that 4 hour order flow lag is, yes, it could push price higher. Potentially, definitely, could potentially happen. Is it a high probability though? No, because we have a weekly order flow lag and we have a weekly fair value gap sitting below that 4 hour order flow lag continuing higher right there. So that is what the time frames then, that makes it so important to understand those different time frames as well. Now, looking at New Zealand dollar, US dollar, what are we seeing? Monthly basis, again, we are quite lucky because we do have a fair value gap to deal with right there, which makes everything a little bit easier to understand. We are rejecting off of that currently. Perfect. What can the next candle aim for? Well, potentially that previous month's high. We did not reach yet. All right, that's quite nice. So we still have a clear target, a clear premium rate. After that, the premium rate can become that high right there. Now, if we move on to the weekly, do we have then a weekly order flow? So can we now find a fair value gap to actually support that idea of continuing higher? No. Okay. All right. Well, then let's go on to the daily. What we still can do on the weekly is, again, the same candle signs, right? So for example, this high was the first target on the monthly. After that, it was this high right there. Now we can refine that target a little bit more because now the target is, for example, this weekly fair value gap sitting right there. So that gives us a little bit more accurate price action on what we are actually dealing with. Now, again, do we have any fair value gap right here on the weekly to support the idea that we might want to continue higher? No. Okay, so we can move into the daily. Daily, do we have a fair value gap and order flow lag higher to support the idea that we actually want to continue higher? Yes. Okay, we have this one right there. So let's dissect this again. We are having this fair value gap sitting right there. And that fair value gap is what we can continue higher off of right now. Now, this is where eventually what we want to work towards is right now. We do not need to wait for that candle close. The next candle close will tell us again, will help us in understanding the lower time frame. But as soon as we come into and we have found the fair value gap, or we have found the PD rate that we can continue higher from, once we reach that specific PD array, we can go into the lower time frame and work our way down again to just simply find the order flow lag that is pushing price higher right now. So on the 50-minute, we see we have a 50-minute order flow lag right there. We are about to create potentially a new order flow lag higher right there as well. So that is where eventually that leads to an entry pattern. So that again is a very early understanding. I do not want to dive too deep into that just yet, but that is how we eventually work our way down as well. Now, in order for us to understand this, because we can't understand this just yet if we don't know how far price can actually retrace, which is all things we need to go over first. So we have a brief understanding of the time frames, the bias, and the narrative, how we combine those different things right there. Now we can move on towards the practice, because practice right here is find the bias, then find the narrative. So what I just did on those time frames, on the monthly, the weekly, then the daily, seeing, first of all, do we have candle signs to support an idea of where we might head towards? Then finding that order flow lag that we can actually continue higher from, and then dissecting that order flow lag with those flood, odd, lot, with those PD arrays as well. So again, before we can actually move on towards the entries, like the last example I just showed you, we need to first understand a retracement. So how far can we actually retrace? Which PD rate do we actually want to continue higher off of? So how can we get more accurate with that? After that, on Friday, we need to go over the resistance as well, understanding the high probability versus the low probability conditions as well. All right, perfect. Thank you.